Good evening, everyone, and thank you for attending tonight's presentation. We'll get started. It's right on 6 p.m. The presentation tonight will run for approximately 20 minutes, and then towards the end, there'll be an opportunity for a question and answer time. Thank you to those that have already submitted through some questions. You can do that by down the bottom of your screen, either talking in the chat or there's a Q&A button as well that you can click on. Our speakers tonight will be Brett Nelson, who's one of our owners and directors of Natgen, Peter Tills, Head of Funds Management, and Lachlan Pappas, our Acquisitions Manager. The presentation will include a brief overview of Natgen, the types of investments that we offer, and what we strive to achieve for our clients. We'll then do a quick walkthrough of the trust itself. As always, these presentations are of general in nature, so please reach out to your trusted advisor or accountant to talk about if this investment is right for you. I'll hand over now to Brett. Thanks, Brett.
Thank you, Caroline, and thank you to everyone who has joined us here tonight on our CA25 webinar. It's great to see so many people online, and I hope you all get something valuable out of tonight's presentation. Natgen was founded in 2019 by Stephen Goaks and myself, with the aim to provide investors consistent monthly income and capital growth through purchasing or building commercial property. Our focus has been helping new investors find value in commercial property, as well as helping existing commercial property investors diversify their portfolios to the various different asset classes that Natgen offers. Since 2019, Natgen has grown conservatively to over $200 million of property under management, made up of 14 different investment trusts. We've purchased $49 million of commercial property in the last 12 months. And I specifically mention this point as for those of you who have been following Natgen for a while, may have noticed that we didn't purchase any freestanding commercial property assets in 2023. I like mentioning this point because it demonstrates that our Natgen investment philosophy of only purchasing assets when we believe we can find real value for our investors. So basically, we don't just take something into a fund because it appears and it's there. We have a very specific strategy for what we buy for our investment funds. And we look at hundreds of assets every year, which Lockie will tell you more about, to find the 4 or 5 that we finally decide to purchase. The first product that we offer is the Natgen Investment Trust, which is mainly focused on providing income to investors. CA25, which we'll be discussing tonight, is an example of one of these, where we target an asset, we do our due diligence, we acquire it, and then we operate it for our investors to provide them with ongoing regular monthly income. The second limb of our business, which you may have seen, is the Natgen Development Trust, where we find a development site, put together a development project, and build it with the help of our investor funds. And in fact, we like to think that we're unique in our Natgen Development Trust, as in these types of vehicles, investors stand effectively in the shoes of the developer and hopefully come out with the development profits at the end. And our third type of Natgen fund is the Natgen Deposit Fund, which is due to be released shortly, and is basically a cash deposit fund where investors can put their money in and make a return based off the official cash rate, plus about 35 bips through us managing various term deposits. And we came up with this idea because we understand how painful it can be for people to shop out the best term deposit rates. Setting up a new bank account with different banks is not an easy process, and Natgen wants to do that to help its investors out. The Natgen Deposit Fund will have a 30-day liquidity, and we're hoping to release some more information on that shortly. I'd like to hand over to Peter Tills now, our Head of Funds Management, to talk more about Natgen and investment trusts and more specifically CA25. Thank you, Peter.
Thanks, Brett. Good evening. Look, I just thought I'd start. Natgen investors will be familiar with a number of these property investment concepts that we're going to run through, but this is more for the benefit of our newer investors that might be so familiar with these points. If you're interested, I'm just going to go over it briefly, but if you're interested in more detail, there's plenty of collateral on our website, and you'll find that under the Knowledge Centre Hub. You should also speak to your accountant or financial advisor, depending on how some of these concepts may relate to your personal situation. Here we've listed the 3 types of property returns that you can expect to get from a Natgen investment trust. The first one comes from the distributions, which are largely from the rent that we collect from centres like Centennial Plaza. The second relates to the fact how some things are treated in terms of tax. So income is essentially turned into a deferred capital treatment for tax purposes. And that's because certain expenses like the depreciation of plant and equipment or debt costs, things like that, can be allowable deductions or costs, I should say, and help that turning income into capital. The final one is because you're a property owner, you're actually owning real property, that there's always the potential for capital gains upon the sale of that particular asset at the end of its term. When we're looking at long-term property returns, this particular chart is provided by MSCI Real Assets, and MSCI literally track all the institutional trades that have been happening in big office assets, big retail shopping centres like the Westfield type shopping centres and big industrial estates. This has been charted since 1990, so over 35 years worth of data here. And a couple of things I'd like to point you to have a look at. The first being that income returns are very consistent. That's the orange bars that you can see on the screen there. The second is that the blue bars, they represent the capital growth potential the capital growth that happens in property. And it sort of really illustrates that property cycle that we see. If you exclude COVID, which is that 2020 period, for the most part, the property cycle is quite a long cycle, and there's more positive moments with capital than there are negative. And the orange line itself combines the two, which is the total return of property. And you'll see that for the most part, again, it's been positive, and that's because of that income characteristic. Now, the orange line has actually deteriorated when the Reserve Bank started tightening interest rates back in 2022. And you'll see that even though it looked a bit dire there toward the end, there are actually green shoots with the September data that's come through. And we expect that trend to continue for the December data, but we don't have that yet. That's probably in a month's time. As a property investor, you always want to find value. And that's why at Natgen we're looking for mispriced assets, which means we buy well, but also actively plan and manage the investment well. In order to narrow our focus, we've developed the Natgen investment philosophy to reflect where we see opportunity in 5 key areas, and that supports returns for our Natgen investors. And you'll see that these areas include regional convenience retail centres, just like Centennial Plaza. The second is non-capital city CBD office assets. The third are industrial assets with rental reversion opportunities. The fourth being specialist assets, and that's just like our last trust, which was a medical centre on the Gold Coast. And the final one is development, which Brett touched on. Now we'll have a look at the key drivers of property returns. And property returns, I can measure it with the value that gets created over time. Returns are based on income growth and other factors such as perceived value of the location or the quality of an asset. So when looking at these types of factors, some drivers are actually macroeconomic in nature and quite quantitative with obvious direct impact, and others may relate to property-specific factors which may be harder to quantify. And that's why we've created a process around asset selection in the Natgen selection criteria, which you'll actually see on page 20 of the information memorandum. It essentially combines the science with the factual components with the art to property investment. We've outlined some important drivers here, such as population growth, demographics, economic growth, supply and demand fundamentals, including the cost to replace an asset, interest rates, which of course can impact who's a particular buyer and how things can be funded, inflation, and other property-specific components. If you have a look at the chart on the right-hand side there, you'll see how this kind of pulls together. And this tracks retail sales, and you'll see that population growth is a pretty important factor, as is the real per capita spend and inflation. And that's sort of what we mean by looking at the various components in some detail, because then in turn that impacts the trading activity in centres like Centennial Plaza. Now that we've got a bit of an understanding of these key concepts, we'll take a look at our latest offering, CA25. The purchase of Centennial Plaza reflects the Natgen investment philosophy, being a regional convenience retail investment well located in the heart of Cooma. We've got an immediate valuation advantage because we're purchasing 40% below the independently assessed replacement cost. It also means that not only are we buying it well, but it also means it's prohibitive for other centres to be built to compete. The tenant mix is mostly blue chip, with the likes of Coles, the Reject Shop, Commonwealth Bank, etc. as tenants. And we're purchasing the centre for $13.725 million, and we'll be funding 50% of that using debt from one of the major banks on our panel. Just to give you we're just working through this part of the process at the moment, but just to give you a guide, our previous trusts have been funded through Commonwealth Bank, ANZ, and St. George. Other aspects of the financial information you'll be able to find on page 21 of the information memorandum. And then finally, in terms of the three types of return that we just spoke about earlier, in terms of the income, we're targeting monthly income of 8% per annum paid monthly over the life of the trust. On average, 84% of that income will be tax advantaged. And finally, as an asset owner, there's always potential for capital growth at the end of the anticipated 5-year term. In terms of location, Cooma is located around 106 kilometres south of Canberra, where the Snowy Mountains Highway and Monaro Highways meet. It is Cooma, or the Snowy Mountains Airport, around 16 kilometres southwest of the town, and that provides direct access to capital cities like Brisbane and Sydney by air. And it's because of this location that Cooma is considered the gateway to the Snowy Mountains. When considering assets for the Natgen trusts, we go through the Natgen selection criteria screening, and we use a range of data sources to work through this. These include the Australian Bureau of Statistics, New South Wales Government or local government authorities, valuation reports, and third-party providers like ID Demographics. What you can see here, though, is that the region's economy is actually diverse. It's not all about tourism. It's got 4 key pillars, tourism being one of those, but electricity generation, agriculture and forestry, and manufacturing being the other. In terms of tourism, Cooma acts as a critical gateway, and this means that 2.7 million people flow through this region each year, each of these people requiring essential goods and services, and that benefits the town and our centre. The other key pillar is the electricity generation, and this has been a mainstay in the region for over 75 years. The Snowy Hydro project produces 1/3 of the nation's renewable energy. The federal government has recently expanded this scheme with a further $12 billion investment in Snowy 2.0. And just as an aside, the actual main office is just located down the road from our centre in Cooma. Lachlan Pappas will now take you through Centennial Plaza. He's our transactions manager.
Yes, hello everyone, and thank you, Peter, for some very exciting points you touched on there. Now, during my recent inspection of Centennial Plaza, I was pleased to note, notwithstanding it was an off-peak period, the shopping centre was vibrant and bustling with activity. Of course, in a centre of this type, the anchor tenant generates much of the volume of customers, and this remains true in this centre also. Now, when considering a regional supermarket, we look to ensure the other majors are established and trading. In the past decade, Aldi has emerged as a competitor positioning itself on the outskirts of town, and their presence has not detracted from the strong performance of Centennial Plaza. In fact, sales at the plaza have remained consistent, highlighting the strong physical position of the centre itself on the main drag there in the Cooma retail strip. What truly distinguishes Coles here is their seamless integration into the plaza itself. This really sets them apart from standalone competitors like Woolworths and Aldi. Coles accounts for approximately 50% of our total income, and their lease is secured until 2030 with an option to extend for a further 20 years. This long-term agreement provides us with substantial stability and predictability in returns also. Now, prior to my visit, I conducted a thorough desktop analysis of Centennial Plaza. The data and projections I reviewed aligned with what I observed on site, and which validates our strategic approach towards acquiring these assets. Additionally, with 75% of the tenants listed on the ASX, Centennial Plaza benefits from a diverse and financially strong tenant mix. This diversity enhances overall market presence, and this is a matter we seek to ensure in our acquisition activities. Now, the lease portfolio demonstrates strength and diversity with a weighted average lease expiry of 3.77 years. The anchor tenant is supported by major banks like Commonwealth Bank of Australia and Bendigo Bank, ensuring steady foot traffic and credibility. Now, the Reject shop, which is well known for excelling in sub-regional areas, serves here as a local staple, and it offers everyday essentials that keeps customers coming back. And just off the back of that, I note that the on-site cafe also adds to the visitor experience, while specialised tenants, including an NDIS provider, which is backed by government funding, enhances stability and broadens our revenue base as well. Altogether, this balanced mix supports dependable income and sets Centennial Plaza up with the potential for long-term growth. We are also in discussions with a new tenant, a major national service provider, a familiar presence in Australian shopping precincts, offering essential community services. This tenant would occupy a prime strip mall vacancy and simultaneously address an upcoming lease expiry, creating a tremendous advantage for the centre by boosting its visibility and attracting even more customers. I do note as well that during our due diligence, we engaged the professional services of PEP Solutions to thoroughly assess Centennial Plaza's mechanical and structural integrity. Now, their evaluation confirmed the building's sound quality and highlighted any necessary works needed during the life of the trust. Now, this proactive approach underscores our commitment to maintaining a resilient, high-performing asset, and it was a process we were happy with moving forward to secure the opportunity. By the way, a synopsis of the due diligence activities undertaking and consideration of the acquisition of this asset is included within the IM on page 30 for those interested in a deeper dive. Peter, you mentioned this before, and in terms of securing and purchasing the assets well below the replacement cost, and in this case assessed at 40% below replacement value, truly underpins the future rental growth of this centre. This acquisition aligns with Natgen's acquisition philosophy, which focuses on identifying mispriced assets with strong growth potential. Now back to you, Caroline, to sign us off.
Thank you, Lockie. So everyone on the call would have previously received a copy of the information memorandum. You do need to read that in its entirety to consider an investment in the trust. It's for wholesale investors only and a minimum of $100,000 investment. We're currently sitting at just over 80% subscribed. We launched this on the 18th of December, so this will be wrapping up over the next week to 2 weeks. So if you would like to consider submitting an application, speak to your financial advisor or accountant. You can apply either through the investor portal on our website in the top right-hand corner, or you can contact the investor relations team and we can send you out a paper copy. We do need other documentation such as identification, copies of trust deeds or unit trusts. You can invest via a superannuation fund or a family unit trust, a company or in individual names. That was it for the presentation. We've had a few questions come in, so we will go through those. And in the meantime, if anyone on the call has any other specifics they've thought of during the way, please just type them in the chat or in the Q&A box. What yield have we bought the asset on? Lachlan, did you want to cover off on that one?
Yes, so quite simply, we've purchased the asset at a passing rent of 7.89%. Quite simply.
And other centres regionally have been going in the 5s and 6s, I believe, Lachlan.
Yes, I agree. I do have a list of comparable sales data that we have gathered from external valuers, etc., that do support the claims that, particularly for centres of this kind with either Coles or Woolworths and Aldi tenants, they typically are transacting between 5.5 to 6%. So it definitely underscores the matter of our Natgen's acquisitions philosophy, which is buying mispriced assets in the market.
Sure. Thank you, Lockie. Does the shopping centre flood? Which simply, no, it doesn't. Are you able to tell me about the investor exit strategy? So typically the term of the trust is 5 years. In the 5th to 6th year, the assets are sold back on the market, and that's how you then realise your initial capital that you've put in, and then you would receive back any capital profit that's been achieved during the 5-year term of owning the asset. Peter, you might like to answer this one. Is the targeted 8% return based on the reliance of interest rate cuts this year?
No. So essentially, there's several things that come into play. There's the actual margin that we can borrow over the bank bill rate, but we've essentially used the bank bill rate that was the swap rate that was available at the time, which is the going rate. So we do add a little bit of a margin to it for error, but we base that information on what the major banks are saying about what they think is happening with interest rates rather than us guessing.
Thanks, Peter. Brett, I might pass this one over to you. Just in terms of what's our plan with tenants that we think to be need to be replaced, do we have any backfill solutions, which Lockie did touch on with a major Australian tenant that's looking to come in?
No problem. I think it's worth mentioning, which we haven't actually discussed tonight, that We've negotiated an 18-month rental guarantee for all the vacancies that are currently on the property. So, notwithstanding that there is a major that we are discussing to take up one of those vacancies and one that's potentially coming up for renewal with a far better, stronger brand. We do have an 18-month rental guarantee in place to secure any vacancies that we can't fill for the first 18 months. As with all Natgen properties, we spend a lot of time when we purchase the asset managing it, and the very first thing we do is set up a pretty serious marketing campaign to get those vacancies filled. Now, in the case of Centennial Plaza, they're not very big spaces there, so we don't think that there's going to be a very likelihood that it's going to be hard to fill them. Of course, one of the questions we get all the time with this asset and other assets where we have the tenants is, what is your plan for the banks? The banks seem to be exiting some regional towns, although not all of them. And in this circumstance, we've got Bendigo and CBA. So, we don't think either of those banks are going to leave, but if they do, we'll get onto them, very early on and find a replacement tenant to fill those. And if that is within the 18 months, then we'll have those covered by the rental guarantee. So hopefully that answers your question, Caroline. But if anyone wants to discuss those in further detail, we're happy to talk to you about our property management division and how we handle all of our tenancies and especially the vacancies.
Yes. Peter, this one might be best for you. What's the projected employment number for Snowy 2, and what is there an expected number to be retained on completion of the project?
Yeah, I mean, look, I've read a lot of different reports, and it's a couple of thousand over the course of the scheme, and a lot of that sort of revolves around the construction aspects of, the tunnels and all the interconnectedness and the like. I do believe, though, that the ongoing management requires less. And again, if you actually look on the Snowy Hydro website, they're not overly forthcoming with what they see as those numbers eventuating, but it's safe to say that, it's in the hundreds at least.
Thank you. Is there a risk of Coles over trading in this site and needing to relocate to a larger footprint? Brett, did you want to answer that one?
Yeah, absolutely. I mean, in the terms of Coles over trading, we've had a look at their turnover figures, and they have about a steady, around about 3% growth every year, 3 to 4%. Taking out the inflation around COVID there. I think that's probably a pretty low risk. And on the flip side of that, for someone to be able to build a new Coles shopping centre in Cooma and then make it feasible for them to do so, they would need to be charging a hell of a lot more rent than what Coles currently being charged. So I think that is probably fairly unlikely. And really that just comes down to building costs and what it would cost to replace the asset. I think Lockie and Peter both mentioned 40% below replacement costs. So, if someone had to go and build that Coles shopping centre now, it's essentially going to cost them at least 40% more than what we're buying it for, which means, if you relate that straight back to rent, they would then need to charge 40% more rent. And, I don't think that's something Coles is ever going to pay for. They're not going to take a, 30 to 40% rental increase just to find a bigger centre. So, we don't see that as a big risk in this centre. The Coles turnover is consistent, but it's not out of control. So that's not something that we see as being a huge risk to this trust.
It's also a full line Coles at the moment anyway, so it's got everything there, and it's trading close to the turnover rent.
Yeah, they'd have to be doing something extremely abnormal to want a bigger space. And in a town like Cooma, that just doesn't seem likely.
Thanks. Do we have a hedging strategy on the debt? And this is sort of two questions, two different people, so I'll combine them. And do we fix or cap debt within our products, which we do? And I'll either your Brett or Peter.
Yeah, we can answer this one together, Peter. I mean, we have the ability to do various different hedging strategies at Natgen with the amount of money that we borrow. We can put, obviously fixed rates is a simple one, but there's more complex ones with caps and collars and things like that. The way that we've modeled Kuma specifically is just based on a variable average interest rate of 5.4% over the term of the trust. Now, that's not to say that if we see an opportunity, which we've actually been working on recently for our other funds, of the fixed rates being favourable in the trust's favour, we wouldn't make a decision to then fix that or fix a portion of it. But it's not a decision that is made quickly or lightly. The board and Peter, being our head of funds management, we do a lot of work in making sure we're trying to make the right interest rate decision. Unfortunately, the banks seem to get it wrong all the time, and so does the media. So it's not an easy job, but I will say it's something that is on the forefront of our mind every single day. So we have the ability to hedge. Our current modelling doesn't have any hedging in place, but that's not to say that we won't put some in place somewhere between 0, 1, and 5 of the trust. You can add to that, Peter, if you want.
Yeah, sure. Look, we do have models where we monitor this and look at the benefit of locking things in and not. And I think the other point to note is that like ANZ are calling a February rate cut. Will that happen? But if that does happen, that will lower the cost to borrow compared to what we're looking at in terms of this particular trust. But yeah, we sort of look at all these things, and we have hedged things in the past, just depending on where we're seeing interest rates being offered. At the moment, there is a bit of a dip in the 3-year part of the swap curve, but that is eroding quickly. So you're possibly better off at the shorter end on the variable rate at the time being.
Thank you. We've just got a couple other questions. I might answer this one if I'm understanding the question correctly here. What are the risks to your investment amount? I guess you're talking about the initial capital that you're putting into the investment and the risks around that. You are buying the bricks and mortar of an asset, so that's what attracts a lot of people to this style of investment. They're looking for something that's a hedge against inflation, and that they're buying the bricks and mortar, understanding what the tenant risks are within a particular asset, to then get that monthly steady income coming out of it, knowing that it's a fairly liquid investment and that your capital will be released
Tied
back
up.
to you. Yes, and tied up for that 5-year term, and then returned at the end of the trust term when the asset is sold. So I hope that answers that question. If there wasn't any others, thank you everyone for attending tonight. Please email either myself or just the email that's on your screen there, the invest@natgen, and we can certainly answer any other questions that you might have that you think about after thinking about the presentation tonight. We can cover that off for you. So we'll wind that up now. We've just gone 4 minutes over time. So thank you very much, everyone who attended tonight, and we look forward to talking to you in the future.